Hello, everybody, and welcome to a quick presentation about the business and financial aspects of the application process for defence innovation loans. My name is Nigel Walker. I'm the Deputy Director of Lending and Investor Partnerships at Innovate UK, and I have with me my colleague Hemaxi Bhatt, who's the Programme Lead on Innovation Loans, and together we're going to talk to you about what innovation loans are about in very general terms, and then very specifically to talk about what you will need to do if you're applying for defence innovation loans around the business and the financial aspects of your application. All the project aspects and the defence aspects, you need to look at the guidance from the Defence and Security Accelerator, from DASA, because we're not covering that piece. So we're just looking at the loan aspect of your application. So, and we're going to start with an overview of innovation loans overall, and I'm going to hand over to Hemaxi.
Thanks very much, Nigel. Hello, everyone. Okay, I'm going to tell you a little bit about innovation loans. The loans are there really for funding for those later stage R&D projects and for businesses that have got that clear route to commercial success. Will it be accepting single SME applicants, so no collaborations for this particular competition? Loans of between 250,000 and 1.6 million are available, and we will look at funding up to 100% of the eligible R&D project costs. Interest rate of 7.4% will be applied, but there are two periods where the interest is partially deferred, and I'll tell you a little bit more, or Nigel will tell you a little bit more as we go through. Overall, the term is a maximum of 7 years, but there's some flexibility within that, and we'll go through the breakdown of the structure of that repayment as we go through. Okay, so innovation loans, as I mentioned, really are there for those innovative businesses, growth orientated. You must be scaling rather than starting up. And as I said earlier, that later stage R&D project, so experimental development with a clear route to commercial success. There must be some issues around that credit constraint, and at Innovate, we are much more open to taking on those more riskier projects and businesses that maybe than the traditional banks would. As I said earlier, I'll tell you a little bit about how the loans are structured. There are three periods. There's the availability period, the extension period, and the repayment period. And the reason for this is to really help the business upfront with cash flow. So during the availability period, this is when you're going to be going through your R&D. You'll be wanting to draw down the loan. You're able to draw down the loan quarterly in advance, and the period is up to 2 years. At that point, you'll only pay interest on the amount that you draw down, and that's at 3.7%, with the remaining 3.7% deferred to the repayment period. Following on from the availability period is the extension period. This is really when you're going to be looking to commercialise your product service, and this can be up to 2 years after the availability period. Once again, the terms for the interest is exactly the same as I mentioned earlier, 3.7%, with the remaining 3.7% deferred to the repayment period. And then finally, you'll be ready to meet those repayments, both capital interest and also the deferred interest, all totaled up. And that is going to be what you'll be paying for the remaining term at 7.4%. You'd probably say that 2 + 2 + 5 is 9. So what you've got is you've got flexibility in that. You may want 2 years to be able to complete your R&D, draw down the R&D project, a year for the extension period. That's how long it'll take you to commercialise the product. And then finally, 4 years to repay. So that adds up to 7 years. So you can flex that within the maximums that we've defined. We will take security, and what we're looking at there is a mortgage debenture. We don't take any personal guarantees, and with regard to the mortgage debenture, that's really a charge over the floating and fixed assets of the business. And in addition to that, we will be applying covenants throughout the period of the loan. Okay, just to mention what those covenants are. We'll be expecting to see a liquidity ratio of 1.1 right the way through the loan. This is really so that we've got confirmation that you can meet the interest repayments as they fall due. And then as we go through, the debt service coverage ratio of 1.2 times throughout just the repayment period. And this is to provide comfort that you'll be able to meet the capital and interest repayments as they fall due. In addition to the covenants, we will allocate you a monitoring officer who will monitor the project as that goes through, and we'll be asking you to provide us with quarterly management accounts. And in addition to that, annual accounts within 6 months of the year end. And I think really with regard to these financial figures, it's really just good financial practice for you, and we can see how the company is progressing. Okay, so what are we looking for within the application? Well, we're looking for those businesses can demonstrate that they've got a real success there. They've got innovation activities that have the best use for, that have the best potential for the future. We'll be looking at your application in 2 different ways. One is going to be around the quality and innovation of the project. That is actually going to be looked at by DASA and the experienced and relevant people there. Innovate UK will be judging the application and suitability of that and your business to receive a loan and the ability of the business to repay. So make sure that within, when you put your application together, there is that evidence borrowing proposal, that you've covered off everything within the word counts that you've been asked to provide the information within. Make sure that it's a high quality later stage R&D project, that you've got a clear route to commercial success. We're really interested in the management team as well as the project team. And we want you to say to us why you need additional public funding to be able to complete the project. And also why you're not able to fund that project from your own resources or from any other private sector funding. Okay, so this is quite a nice slide that gives us some details about really what we mean by late stage businesses, produced by the Royal Academy of Engineering, and I think it really covers what we're looking at. So it's really where you've got your prototype and you want to take it to that final product. So what are the things that we'll consider? So things like testing and optimization, manufacturing, quality control. Demonstrators, so demonstrating in controlled and real world environments how you want to, where your product is going. Looking at redesign, looking at sort of those digital interfaces, integrating those components, and obviously things like consumer trials and regulations and standards. So as long as your project that you're looking to take forward from that prototype to that commercialization, then this is the right competition for you. Okay, well, competition's already up and running, opened on the 24th of June, and the submission deadline is the 11th of August at 12 noon. There is a link to the competition here, but I'm sure you've probably been able to locate it. All I would say is please make sure that you get your submissions in advance. Don't wait until the last day because you just never know. There can be hiccups, and we've seen hiccups happen in the past. So all I can stress is please get your applications in as soon as you can. And well before the 11th of August, and well before 12 o'clock on that day as well.
So I'm going to talk a bit now about about how you apply. As Himatsu said, the project proposal, the project cost element, that's all handled in the DASA application. You need to make sure that you're responding to the call that they're making, that it fits in with the scope of work that they're looking for in relation to defence innovation. What we're going to talk about, what I'm going to talk about here, is particularly the loan part of your application, where we want to consider the suitability of your business to take on a loan. And therefore there are two parts that are particularly relevant. One part is about the business and business information that we're going to ask from you. That's through the format of a survey, answering some narrative questions, answering some questions that are not quite multiple choice, but less narrative required. And importantly, a financial spreadsheet. We want to see forecast financial figures for you, historic financial figures from you in order to be able to do that. The business information, when you click on the relevant link in the application, it'll take you through to the business information survey. And we want to understand about your business as a whole, not just the project aspect of it. If you want to see that the entirety of that business survey before you launch into it, you can download an example, a PDF of the full survey, so you can look at all the questions, see how they work. But then the actual response to the question is through the online survey. And we do also provide within that survey some guidance on how to answer those questions where if it's not entirely clear. And the questions cover a number of things. So we want to understand an overview of your business. What is your business? What's your core product offering? What's the value proposition that you're offering to existing and future customers, whether that be in the defense environment or more broadly, if you're looking to have technology that meets an initial defense needs, but then has perhaps a wider industrial application. And we want to understand how your business is going to be impacted by this project. How is it going to help you to grow? We want to understand about your loan request. We want to know how much you want to borrow, over what period, and why. The why is particularly important there. We want to understand about your company, about the people. As Hamaxi has said, the management team, the founders, they're really important. We want to understand not just who's going to deliver the project, but who leads the business. Have you got the breadth, the scope, the depth of expertise and capability that you need, both technically and commercially and financially? And that if you have gaps, that you've got a plan to fill those over time, that you've got good governance, etc., in terms of having a proper board of directors, having regular board meetings, all the sorts of things that, dare I say, a grown-up company needs to have. If we're looking at lending to a business, we want that business to have good governance as well. We're really interested in the overall commercial activity of your business, what you've done in the past, what you're doing today, what you're planning to do in the future, what your level of revenue generation is, what sort of customers you have, whether it's business to business, business to consumer, whether it's defense, whether it's more broadly set out, whether it's domestic, whether it's international. So there's lots of questions around your commercial activity. We want to understand about product development. Certainly within your project proposal, you'll talk about that particular project, but we're interested in your overall business. This may be, your project proposal may be for a new product or service that builds on other activities. So we want to understand that other activity and the stage of development that you are at, because that will help us to understand the credibility of the financial forecast that we're going to be looking at in the financial spreadsheet, and your plans for future development. If you're going to continue doing R&D, if you're going to continue bringing new products and services to market as a way of growing your business, we need to understand that from your answers to these questions so that we can judge within your financials whether you've got the adequate resources to keep going in building your business to a greater level. We want to understand the current financial situation of your business, really simple things like what sort of cash levels do you have and what your future financial position is going to look like. What is your funding strategy for growth of your business? Are you going to be looking to generate revenues and profits? Are you going to be raising additional capital from new investors? You might be thinking about borrowing from banks in the future. And we want to understand why a loan from Innovate UK Loans Limited is relevant in this case, why you need public funding, why you can't just go ahead and do this with your own resources. Why should the taxpayer be supporting you through this mechanism? And finally, we want to ask about risk management, about the challenges that you have to growth and how you're going to address those. In your project application, you'll talk about the risk management in relation to delivery of that project, but here we're interested in the risk management, addressing the challenges to growth that your overall business has, because that's a really important part of you demonstrating to us that you're suitable to take on a loan. So those are the questions in the survey. We also need you to complete a business financial spreadsheet. That business financial spreadsheet can be accessed through the survey. You can download it, and you will need to take time and effort to complete the business financials. Because this is a loan, we want to see the financial aspects of your business in quite a lot of detail. So we want to see your profit and loss account, your balance sheet, and cash flow forecasts for the future. We want to see historic figures, so what's happened over the past 3 years. If you're a younger business than that, then obviously that's not going to be relevant. You may only have 1 or 2 years of previous financials. And we want to see financial forecasts that cover the full period of the loan. The cash flow forecast is a particularly important part because we want to see what funding what cash you have coming in as you generate revenues. You will probably have debtors because you don't get paid up front. Maybe you are paid up front. Maybe you're selling in cash, probably quite unlikely with a defence innovation loan. So you will sell to customers, they will pay a little while later, and then when they pay, that's the cash that's coming in from debtors. We want to see any other funding that you're introducing. Are you raising additional equity, and if so, how much and when? The innovation loans drawdown piece will be calculated automatically, and I'll talk about that in a second. We want to understand what cash outflows you have. Obviously, you'll have costs of sales, you'll be paying creditors when you've purchased materials, equipment, assets. You'll have other costs such as administration. You'll be potentially building up inventories over time if you need to hold stock of equipment that you're then selling. You may be paying interest to other lenders if you've got bank debt, and you may be repaying other loans over a period of time. You are highly likely to be purchasing assets, unless you're perhaps a pure software business, that's perhaps less relevant. And you'll be either paying tax or perhaps getting tax refunds in the form of R&D tax credits, if that's relevant for your business. And all of those put together is really important to show the cash inflow, the cash outflow, and therefore your ability to service this loan, to make the payments of interest when they fall due, to make the repayments of principal and interest in the repayment period. In order to complete the business financials, when you get that spreadsheet, this is what it will look like. One thing I would say is, please read the instructions. You will see that there's further guidance on the use of this on the use of the worksheet. If you click on that link to the loan finance guide, we go through almost line by line, explaining how to complete this spreadsheet. And the first thing that you would need to do is to put in the date on which you expect the loan to start and your financial year end. And that will then populate the years relevant in your financial forecast. The next step that when I'm looking at this, I tend then to look at, well, what's the loan about? So how much do you want to borrow? Over what period? Himaxi's talked about the availability, extension, and repayment periods. You need to input what those are, and you need to show how those quarterly drawdowns will happen. So in the example I've got here, it's a company that wishes to borrow £1.25 million. That covers 100% of their project. They want to borrow, drawing down over 6 quarters. So they've shown the anticipated drawdowns, more at the beginning than further on, because they're perhaps purchasing some assets. Then a 1-year extension period as they're getting into the market, and then repayment over a three-year period. If once you input these items into this part of the financial spreadsheet, the calculator, the template there will do the calculations to identify how much interest you will be paying, when you will be paying that, how that interest is deferred, and how those come together into the repayment period to show the quarterly repayments that you would need to make based on the assumptions that are in this particular template. And what that will then do is populate items in the balance sheet, the profit and loss account, and in the cash flow forecast, showing the innovation loan drawdown in the balance sheet. It will show the interest that's payable from a balance sheet point of view, and it will show the cash flows with the innovation loan drawdowns coming in as cash inflows, the actual interest payments, so taking into account the deferral, so the cash payments that are going to be made in each year, and then the repayments of principal and deferred interest and interest in the repayment period. So all of those items will be auto-populated into the financial statements that we ask you to prepare. We also have a tab, it's optional, but certainly recommended, where you can show your sales assumptions. We're very interested in your future revenue generation, so you can put in a fairly simplistic way here, what your particular product or services are, what sort of sales price you have, the cost of sales of those. You can put those in, describe them. You can show the number of units that you're going to be selling, for example, in products 1 and 2 over different periods. This then takes the pricing and the cost of goods sold that you've shown in the previous tab. Those numbers of sales volumes then will automatically calculate, if you wish, the revenues that you'll be generating, your turnover, and the cost of sales relevant to those. And if you wish, those can auto-populate into the business financial spreadsheet. If you think that that's oversimplistic and doesn't represent your business model, you don't have to use those. You can use your own forecast. If you do that, you are perfectly welcome to add an additional worksheet, additional tab to the financial spreadsheet where you maybe explain those to us so that we're not looking at these and thinking, well, I wonder why they came up with those assumptions. So the assumptions are important for us, and it shows those things. So a lot of this information you'll see is building in that financial spreadsheet, and then you will need to complete all the other items that are in there. So any other income that you may be receiving, for example, grants. Grants are not turnover. Grants are other income. So if you're receiving those, you can show them. Other costs rather, so sales and marketing, administration, research and development costs. You'll need to take into account depreciation and amortization on any assets that you have, whether they're tangible or perhaps intangible. Take into account tax as well. And you need to put all the other items into the balance sheet. So fixed assets, debtors, inventories, creditors. We see quite a lot of applications that ignore debtors and creditors. From a cash flow point of view, that doesn't make real business sense. There will be debtors. You won't be paid upfront or in cash. Almost certainly you will be paid after a period of time. And so you need to take into account of those things. Your share capital is really important, and we need to see that. We'll obviously look to make sure that that ties in with the information that's shown at Companies House, and the cash figure. We will always look at the amount of cash that you have, because that's really important from a lending point of view. So here you can see on the screen the balance sheet part of that financial spreadsheet. Here is the cash flow forecast element of it, completing it, showing other loans or equity that's been introduced. In this case, this company is raising additional capital over time. They're purchasing fixed assets, and those need to show through. And the spreadsheet will automatically calculate the cash movements. And one thing that's really important is that the cash that you show on your balance sheet needs to match that you show in your cash flow forecast. So we would always strongly recommend that you have somebody completing this spreadsheet that has the financial capability, the awareness, the experience, the expertise, as well as a good, decent understanding of Excel. Not that it's hugely complex, but it's the financial aspects that are really important. There are some simple auto checks in the balance sheet. If your balance sheet doesn't balance, it will state no in this case. That's a bit of a no-no certainly for me as an accountant. If I see a balance sheet that doesn't balance, I will get slightly worried about it, because it implies that someone's not doing something in the way that they should. We will look at what used to be called the undertaking in difficulty, but we will look to see that relationship between your share capital and share premium and any other reserves against the accumulated profits, or quite often accumulated losses that we would see from innovative R&D intensive businesses. As I mentioned, the cash needs to match between the balance sheet and the cash flow forecast. If it doesn't, it calls into doubt the financial capability and the plausibility of the numbers that you're showing. And it'll show that liquidity ratio, so the relationship between current assets and current liabilities throughout the period of the loan, and during the repayment period, the debt service coverage ratio, showing that your EBITDA, your earnings before interest, tax, depreciation and amortization, should need to be at least 1.2 times the excuse me, need to be at least 1.2 times the amount of interest and principal repayments that you will be making in the repayment period. The template will automatically calculate the loan to project value. You can borrow up to 100% of the project costs. Because this is a subsidy, it will calculate the gross grant equivalent of your proposal, and also the intensity rate, so what the equivalent of a grant would be. The project proposals and questions and the project cost elements, we're not talking about in this particular recording. That's all covered by DASA. If you have any questions about that, then please contact the folks there. And now, since I'm about to cough again, I'm going to hand over to Hamaxi.
Okay, so let's look at submitting your application. So just to quickly go through the process, your application will go through once you've submitted it. So as we've already said, there's two parts. There's the project part and the business and financial part. As you go, when you do the application, it's all going to be on one particular portal, so you'll go through that. Submit by the deadline. As I said, try and get that through as early as possible. Once we get to the closing date, once we'll look at all the applications, we'll look at the scope and the eligibility initially, and any that fall outside that eligibility criteria will basically be discounted, and you'll be advised that you haven't been successful due to not meeting the scope or eligibility criteria. And at that point, the project part of your application, it will be assessed by DASA and their specialist assessors. So they've got the expertise in the areas that you're looking at. And the credit part will be evaluated by Innovate UK. So that's the business side of things. Once there'll be a date when all of these assessments will need to be completed by, and we will then get together the credit team as well as the DASA team, and we will look at where your application comes through along the innovation criteria, and where it meets the credit triage criteria. Just when I talk about the credit triage, what that means.
Talk about that in a second.
Yeah, okay, I'll let Nigel talk about what that process is. So yeah, going back to having done the initial assessment and the review, those applications that meet the criteria will then go down to the next stage, i.e. that's the detailed credit analysis. Any that don't meet the innovation criteria or fall at the hurdle with regard to being suitable for a loan because can't meet the repayments or any other reasons, will be advised that they've not been successful. And you will get some feedback on the reason why. So those that are successful, as I said, will go through to detailed credit analysis, and thereafter there'll be a period where that assessment process is completed, And once that assessment process is completed, we'll go out and let everyone know who's been successful and who hasn't. Those that have been successful, once again, will be advised and feedback provided. And those that are successful will move to the next stage, where we will start going through the normal due diligence and producing the loan documentation. So there is a process to go through once the competition closes, and the various different dates are advised in the competition brief.
Okay, thank you, Maxi. I'm going to talk a little bit about how we do that, that assessment and credit evaluation. As Himaxi said, there's two stages. The first stage is it innovative, and from a credit point of view, has it passed the initial review? Some applications will be unsuccessful at that stage, and we'll notify you of that. Some applications will progress further. That doesn't mean at that stage that they have been successful. It means they move on to the next stage. And in the second stage, we will look at detailed credit analysis. It'll come to the credit committee. Some may be declined at that stage. Sometimes further information will be required, sometimes a management presentation, and then some businesses will be successful, and we will make a loan offer, and need to go through the documentation process in order to complete the loan and then start to move into the borrowing stage. So how do we think about credit? That initial credit review, when we look at your initial applications, we look at things fairly simply. We want to know that you're going to be able to pay the interest, you're going to be able to repay the loan, that you need public funding. And we put things effectively in a number of buckets. We'll have some applicants who don't yet have any revenues, who don't have adequate capitalization, and who don't demonstrate to us a sensible, adequate funding strategy. And for those, we'll probably think that a loan is not suitable and that we would not be responsible lenders. So that's likely to be a decline. There may be businesses that have minimal revenues, certainly operating losses as they're investing in R&D, who maybe don't yet have sufficient cash on their balance sheet, but who have a proposal for raising equity. There, the more highly innovative, the more likely then that we will say that we would progress to more detailed analysis. There may be businesses that are generating revenues, that have balance sheet cash, that have a plan for equity. We'll just want to make sure that, yes, they are in the innovative category. And then there will be some applicants who look pretty solid from a credit point of view, generating revenue, making profits, have cash, have raised equity and continue to do so, who are innovative. And our question there would be, well, actually, do you need public money? So we will look at all of those sorts of things in that initial credit review, and we will then carry out a process of bringing together is it an innovative project, and is it a suitable business? It's biased slightly towards innovation. We will take into account those that, from a credit point of view, that we recommend, those that are marginal. We'll take into account the innovation score and the credit, and we bring those together to decide who progresses then to the detailed credit analysis. Those businesses, applications that go to the detailed credit analysis, we will look at things in a fairly traditional but forward-looking way. So we'll be interested in the character of the company, the previous red flags or amber flags that we might see if there are county court judgments, for example. That calls into question the commitment of the business to meet its obligations. We'll look in detail at the management team. We want to understand the capability and capacity of the whole business, the commercial capacity, the technological capacity, the financial capability. We will look at liquidity and affordability. Cash flow is really, really important to us. I've stressed on a number of occasions the leverage ratio, the debt service coverage, the need often to raise additional capital. We will look at those. We're really interested in the market. We're looking at your future cash flow forecasts. So we want to see that you've presented in your application a really good understanding of the market, the competitive position, where you fit your innovation risk, what regulatory risk might there be, and control culture, the governance side of things is particularly important, and so we will look at that as well. We do take collateral, but we do not ascribe any value to that collateral. This is not a collateral-based loan. This is a loan based primarily on future cash flows, where we also take security, but we will not be carrying out a valuation of any collateral. Our decisions are made by the Credit Committee of Innovate UK Loans Limited. I'm a member of that committee, and that happens following the detailed credit analysis. If a loan offer is made, we have a standard loan agreement, we have a standard debenture template. Execution is electronic, which is just as well since we're not getting together as much yet. Even when things open up more, it's a very practical way of doing things. We will need to go through the standard processes of know your customer, anti-money laundering check, looking at politically exposed persons, and we may impose specific conditions in a loan agreement, either before you can start to draw down or maybe afterwards. So conditions might include, for example, completing a capital raise that you've shown in your application, or it may be that we feel that it's essential for your business to commit to complete the hiring of a senior commercial person, if that's set out in your proposal. And it may be that if you haven't done that, then we won't fund you any further until that condition is met, and then funding can happen. We will need to see that you have corporate authorization. This is a company borrowing money, and therefore it needs to be authorized in the particular way set up by your company, shareholder approval, directors approval, etc. So we need to know that it is authorized. And then for those successful businesses, going back perhaps right to the very beginning of what Himaxi was saying, this is how it works. So your first drawdown would be when the loan agreement is completed, any conditions have been met before the loan can start. You've submitted a compliant drawdown notice saying what you want your first quarterly drawdown to be, and then we will arrange for funding to be paid away to you. Subsequent drawdowns will be quarterly in advance to fund the R&D costs in your project in the following quarter. We'll be looking at the progress of the project and the financial information that you will be providing to us each quarter. And as Himaxi has said, we'll charge interest quarterly in arrears based on the amount that you borrowed, 3.7% payable and 3.7% deferred to the repayment period. When your availability period is complete, when your R&D phase is over, you will go into the extension period. That's when you're getting to commercial success. No further drawdowns in that period, but not yet making any repayments. That will end on the earlier of the date that you'd agreed in your loan agreement, or if earlier, when the first commercial sale from the results of exploitation of that project occurs. And we'll discuss that with you at the time if relevant. Again, because it's still in the project, interest is quarterly in arrears, 3.7% payable based on the amount outstanding, and 3.7% is deferred. There will still be monitoring by the monitoring officer on the exploitation. You will still be providing information to the credit specialist and our portfolio team about your financials to show that you're compliant. And then at the end of that period, you get to the repayment period. Again, no further drawdowns are permitted in that period. And then in that period, the deferred interest is added to the amount that you've borrowed, and interest will be payable at 7.4% on that overall amount. And there will be quarterly level payments over the repayment period. The monitoring officer drops away because your project is complete, but we will still be interested in seeing the financial information from you, quarterly financial information. We'll check against the covenant compliance, and hopefully you won't hear too much from us. You'll maybe have an annual review. If we talk to you more at that point, it's probably because things aren't going according to plan, and we need to discuss with you mechanisms to make sure that we're being responsible and you're able to meet your obligations. These are risky proposals that you're putting forward. These are risky businesses that we're going to consider lending to. We know that problems will occur. Delays are inevitable in anything relating to R&D and innovation and getting new products and services to market. We think that by tying in with DASA and the defence side of things, there's a strong likelihood that you may have an initial customer perhaps in one of the services. That's good, but as I said, delays happen. Pricing can't always be certain. Costs often increase, and therefore, we will be looking closely from a financial point of view at how things are going for the future. We will be responsible, but we need to remember that this is a loan. You will have an obligation to repay, and if things go horribly wrong, we will have a security interest, and we will, acting responsibly, ensure that we're managing public money properly. Hopefully, though, everything's going to go spectacularly well and according to plan, and you'll have a super duper new product or service. You'll have an intelligent lead customer in one of the services in relation to a defence application. You may be able to grow then even further with other applications, and therefore there's going to be a really strong growth opportunity for you. Good economic impact for the UK, and a recycling of money through your repayments that can then be used to fund further defence innovation opportunities in the future. So I'll wrap it up there and say thank you for listening. I hope that that has been helpful, and just leave a couple of tips for you on completing the business and financial parts of the application. Please read the instructions. We spend a lot of time and effort writing them. We really want to help you, and therefore we've written them in detail. Please prepare, think about it, don't do things at the last minute. Do take financial and legal advice, it's really important. Please submit all parts of the application, otherwise it will be rejected, and make sure you complete all the parts of the business financials that we ask for, covering the full loan period and making sure that things match. Describe the assumptions that you're making. Think about sort of top-down revenue generation opportunities at a market level, and bottom-up in terms of how many units you might sell, etc. Think about the costs and make sure all the costs that are needed to deliver your ambitious growth plan are included there. Think about sensitivities, think about stress cases. We will run sensitivity analysis if we get through to detailed credit analysis. We will think about delays, reductions in revenues, challenges around pricing, costings, etc. Please have adequate capital. We see a lot of undercapitalized businesses in the UK, particularly innovative businesses, and we want to make sure that risk capital is there and that we're not simply substituting for the risk capital that shareholders need to take. Consider your cash side of things, that's really important throughout the period. Realistic needs to be the order of the day, and please submit all the parts of the application on time, as Maxi has said. And final piece of advice, please read the instructions. That will give you a better chance of making a really good defence innovation loan application. So that's basically all we had to say. Thank you very much indeed for your attention, and I hope this 45 minutes of briefing will help you in submitting a really good application. Maxi, thank you very much indeed for setting this up, and goodbye.